At that meeting, it's broadly anticipated the Fed will cut interest rates by 25 basis points. However, a new view has begun to emerge in the markets, looking for a 50 basis point rate reduction at that meeting. We think that largely the employment report scheduled for this Friday could dictate the degree to which the Fed does cut interest rates. However, before we get to the employment data, there are a couple of other important economic data releases worth discussing. First out this week is the November Manufacturing ISM survey. That data has already been reported and showed the conditions in the manufacturing sector basically unchanged from the prior month. However, in one of the key details of that report, the employment component dropped to the lowest level in over 4 years. This indicates that we should continue to see layoffs in the manufacturing sector. Also out on Monday, the November report on motor vehicle sales will be reported by each individual automaker throughout the course of the afternoon. We're looking for a number, an annualized sales figure, to drop below the 16 million unit rate. The auto sales data are significant because they are an important gauge of the status of U.S. consumers. There are no economic data releases on Tuesday. However, on Wednesday we have two key reports, the first of which is the ADP employment survey. This is a private sector employment survey, and it's a useful gauge for predicting what private sector employment will look like on Friday's payroll report. Also on Wednesday, we get revisions to Q3 productivity. Following a 1% upward revision to Q3 GDP, which we learned of last week, we expect productivity to be revised up to 6% in the quarter. On Thursday, the only report is the weekly jobless claims figures. We think that report will get only passing attention as the markets hold their breath, so to speak, ahead of Friday's report. Moving on then to Friday's data, we have two key reports. The most important release of the week, as I suggested, is the November employment report. We're looking for about only 75,000 new jobs to be created, and we expect to see ongoing layoffs in the construction sector, the manufacturing sector, and particularly in this month, we think the employment numbers will be impacted by the writers' strike on the West Coast. In terms of the unemployment rate, it's been running right around 4.7%. We expect it to stay at that level. However, the risk is that it could drift a tenth higher. Later on in the morning, we get the University of Michigan Consumer Sentiment Index for the month of December. This is the first read. We expect that to fall a couple of points. That's down over 20 points since the start of this year. The sentiment gauge is important because it tells us a lot about the pain threshold of U.S. consumers as they deal with both resetting mortgage rates and also high gas and energy prices. A number of forecasters for the U.S. economy have become increasingly bearish as of late. We look for the economy to grow at a 1% pace in the fourth quarter and only slightly better in the first quarter of next year. This week's economic data will be an important gauge as to whether the U.S. economy slips into recession in 2008, which is not our view, but it is an increasingly common view among other economic forecasters.